Well, the JSE has been weaker this Thursday morning, along with its global peers, while the rand was weaker in line with emerging market currencies as investors await a key inflation report in the US. Karl Gevers is an independent market analyst, joining us now for a more in-depth look, Karl, at all that's been going on in the last few hours. Let's begin, as ever, with an overview of the market performance so far today.
Yeah, good afternoon. As you mentioned, the markets globally softer, and that's after the US midterm elections so far have failed to prove a decisive direction one way or the other. And then on top of that, we've got China, where we've got expanded lockdowns again after there was a bit of hope that they might be relaxed. And then as you said, the market waiting for that US CPI number, where the expectation is that inflation should come down slightly in the last month. So generally markets softer today. The JSE currently trading 0.75% down. Majority of that coming from the resource sector, where we've had some issues within, for example, the bulk miners, where the coal lines, there was a derailment, also the iron ore line being shut for maintenance, so that leading to Thungela, for example, and South 32 under a bit of pressure, down 5% and 2.5% respectively. But on the positive side, we've got a few positive moves, SAPI being one, up 8% at the moment, Life Healthcare up 1.5%, and AVI also up about 2%.
Let's talk about commodities while we have you. Any earth-shattering developments there?
Yeah, I mean, if one looks at the quarter to date, I mean, the commodity prices have been particularly weak. If one looks at the South African commodities like coal, iron ore, palladium have all come down. So for the quarter so far, they're pretty weak. But if we look at just in the last couple of weeks, iron ore has found some support. And that's on the back of some financial support promised for property developers. So in China, oil has been slightly weaker on growth concerns, again, China related with the lockdowns there, on demand concerns. And then gold has been, waiting pretty much for that CPI print. So a higher inflation number would mean a higher interest rate environment, and that would be bad for gold, and vice versa.
And SAPI Limited, fourth quarter results out from them. That's for the period ended September 2022, as with many other companies at this time of year. And in fact, they've got now a cash dividend declaration. How good is it?
Yeah, I mean, quite an impressive result for SAPI. That's why the share price has reacted positively, up 8% today. So the underlying earnings per share are up 300% for the quarter. And the dividend, as you said, has been reinstated. So that's certainly ahead of what consensus expected for the year. SAPI benefited particularly from rising selling prices of graphic paper and also dissolving wood pulp, some of their major products, and also benefited from increased volumes in the last quarter. There have been, however, some energy pressures in Europe, but those have been more than offset by the benefits that I mentioned. I think the important thing, and that's what the market probably likes, is that they've managed to pay down a significant portion of their debt. So the balance sheet's in a much better position, and they're able to pay a dividend. The outlook, however, is slightly not concerning, but just slightly weaker, given the potential demand impact from the Russian war, the Russian-Ukraine war, and also the Chinese economic slowdown.
Karl, let's end with SATSA publishing the mining production and sales figures also for September. What clues does that data give us about the health of the local economy at this point, and what can we in fact expect from manufacturing data, which is out later?
Yeah, it's the 8th consecutive month of a decrease in mining production, with the September number declining by 4.5% year on year, mainly driven by iron ore and gold, that were impacted by strikes and of course the power cuts, the load shedding that we've experienced. So it obviously doesn't bode well for the economy, because we rely significantly on that commodity production and obviously the commodity prices as well. But if one looks at the manufacturing, it would be impacted by the similar factors like strikes and probably more the load shedding power cuts. The expectation there by the market is that production or manufacturing would have come down by 2.4%. We'll get that number, I think, in the next hour.
Karl Gevers, good to speak to you. Thank you.